In this video, we will explore the core components of Warren Buffett's trading strategy, drawing from his investment philosophy and approach. Whether you are an aspiring investor or simply interested in finance and business, this video will provide insights into how one of the world's most successful investors built his fortune. Warren Buffett's trading strategy is rooted in value investing, a method that involves finding undervalued companies with strong fundamentals that are priced below their intrinsic value. At its core, Buffett's approach revolves around three key principles: value investing, a long-term focus, and a circle of competence. Value investing is the cornerstone of Warren Buffett's approach. He follows the principles of value investing, pioneered by Benjamin Graham, Warren Buffett's teacher and mentor. Value investing involves finding undervalued companies by analyzing their financial statements, understanding their business models, and assessing their future prospects. Buffett looks for stocks that are trading below their intrinsic value, which represents the true worth of a company based on its assets, earnings, growth potential, and other relevant factors. This approach allows him to buy stocks at a discount, which increases the potential for long-term gains. Buffett's value investing approach is complemented by his long-term focus. He is known for his patience and willingness to hold on to investments for years or even decades. This long-term perspective enables him to ride the waves of short-term market volatility and capitalize on the power of compounding returns. By maintaining a long-term view, Buffett avoids the pitfalls of trying to time the market or chasing short-term trends, which often leads to better long-term results. Another crucial aspect of Buffett's strategy is his emphasis on the circle of competence. This principle highlights the importance of investing in businesses that the investor understands well. Buffett avoids investing in industries or companies that are outside his area of expertise, such as technology or pharmaceuticals, where he may not be fully informed about the latest developments and future prospects. Instead, he focuses on companies and sectors that he is familiar with, such as consumer goods, insurance, and banking. This approach helps him make informed investment decisions and mitigate risks by avoiding investments in areas that he does not fully comprehend. Quality companies are another key focus for Warren Buffett. He seeks out companies with strong competitive advantages, often referred to as moats, that protect them from competition and enable them to generate higher profits and returns for shareholders. These advantages can include strong brand recognition, unique products, or cost advantages. For example, companies like Coca-Cola and Apple have built-in brand loyalty and customer networks that are difficult for competitors to overcome. Similarly, companies with cost advantages, such as those that have proprietary technology or efficient production processes, can maintain higher profit margins and outcompete rivals. When evaluating companies, Buffett looks for those with durable competitive advantages that can withstand changes in the market and sustain long-term growth. A crucial aspect of Buffett's investment approach is his focus on a margin of safety. This principle is based on the idea that it is better to buy a good business at a bad price than a bad business at a good price. In other words, he prioritizes investments that offer a margin of safety, which is the difference between the purchase price and the company's intrinsic value. By buying stocks at a significant discount to their intrinsic value, Buffett reduces the risk of potential losses and increases the likelihood of generating long-term profits. This approach allows him to sleep well at night, knowing that his investments are well below their fair value. Strong management is another key consideration in Buffett's investment approach. He places a high value on the quality and integrity of a company's management team. Buffett looks for ethical, competent, and experienced leaders who have a proven track record of making sound business decisions and creating value for shareholders. He understands that the success of an investment can greatly depend on the decisions made by the management team, and therefore he prioritizes companies with strong leadership. Warren Buffett's approach also includes avoiding the herd mentality. This principle highlights the importance of not blindly following the crowd or making decisions based on popular opinion. Instead, Buffett encourages investors to think independently, conduct thorough analysis, and make their own investment decisions. He emphasizes that successful investing often requires going against the consensus and having the courage to make unpopular investment choices. By avoiding the herd mentality, investors can potentially uncover hidden gems and avoid the pitfalls of investing in overhyped companies. In conclusion, Warren Buffett's trading strategy is a result of his disciplined approach to value investing. Long-term perspective and focus on quality businesses. His strategy revolves around finding undervalued companies with strong fundamentals and a bright future, all while keeping a close eye on his investment thesis and avoiding risky ventures. Through his keen understanding of business, patience, and ability to identify hidden gems, Buffett has built an investment empire that has stood the test of time. For aspiring investors, studying his approach and adapting its key elements to their own portfolios can lead to greater success in the world of investing. Remember that while it's essential to learn from successful investors like Buffett, it's equally important to develop your own investment style and adapt to changing market conditions.